Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I'm Arjun Patsarthi. For those who came in late, we have changed the format of Let's Talk Bonds from a weekly podcast to a fortnightly podcast. And the reason is that every fortnight we have also Search for Yields, our weekly newsletter. And the podcast itself is something which a topical which we can dwell upon and enable listeners to understand what are the drivers of bond deals, bond prices, and how best they can use this information um, to position for their fixed income assets for their personal savings, or if you're a financial advisor, how best to position fixed income for your clients. So without much delay, let's go into the podcast today. So typically, the end of January, the beginning of Feb is the union budget exercise, and this year the budget will be presented to the Parliament for on the 1st of February by the Finance Minister, and this budget is for the fiscal year 2023-24. Now, 2022-23 saw a huge amount of government bond supply with over 14 lakh crores or rupees 14 trillion of bonds cross borrowing. This is just a central government, and taking states into account, it went over rupees 20 trillion or over 20 lakh crores. Now, to put this in perspective, it's a very large sum of money that is raised by the union government and the states as well. And apart from this, there are also private sector, corporate bond issuers, and many others who are dependent on bond markets for their funding requirements. So the government themselves drive the bond markets because of supply, and government bond yields, since they are the benchmark bonds, they also determine what is the level of interest rates in the economy. Now, what does the budget bring in? Normally, what the budget brings in is um, more borrowing, because typically the government runs a fiscal deficit, which is in India, they've always been running a fiscal deficit. They have been trying to keep it down, but various things have come in. One was economic slowdown, then one was COVID. So there's something called an FRBM, that is Fiscal Responsibility and Management Act, where they are supposed to bring down fiscal deficit to normal levels, but that's never happened. Government could never stick to this FRBM and always had to postpone it. They keep talking about it, but never happens. And all the bond market sees is now supply and more supply of bonds. Now, at some points of time, the supply is welcome, because if RBI is buying bonds and cutting rates and inflation is low, then investors like to buy government bonds to take advantage of falling interest rates and higher bond prices so that they can sell it now, or they can take a higher interest rates that is available before the interest rate falls. But this normally does not last for too long, and when there is more borrowing and more spending by government, there is more inflation as well. And in this budget, you also have the scenario of taxes. Now, there are talks of taxes. One is on capital gains, which could be increased. Then you could have more taxes, because the government typically does want to spend, um, and especially now they're going into elections in 2024, and any government would like to keep the economy robust, and that would mean more spending. And if that means more spending, they either have to raise the funds for spending by borrowing and also by increasing revenues through taxes. We don't see too much of increase in personal tax, but there is some talks of capital gains tax increase, and also for more importantly for debt segment, uh, they could make all fixed income bonds, that is any debentures that I issued, as a 3 year minimum 3 years holding period for availing of indexation benefits. Now, this could mean that a very large market, which has risen with this called the MLD, which is a MLD market, market linked debentures. They were treated almost like equity in terms of capital gains with 1 year taxation. Now, that could come into a 3 year period, and this MLD market could see some kind of a slowdown, largely because 3 years plus minimum investment horizon. And once the maturity becomes less than 3 years, it becomes illiquid. So there would definitely be a large reluctance by investors who have been availing of this tax benefit of a 1 year plus in taxation. Now to hesitate, they would hesitate to lock in their funds for 3 year plus. And many companies have been accessing this MLD market at cheaper rates because of the indexation benefits available. They would have to come into the regular bond market to borrow, and that could raise the cost of funds also. And the markets can be choosy, and this especially weaker borrowers who have been accessing the MLD market for funding can see some kind of a liquidity issue if they're not able to plug the leak in the liquidity due to in case this tax tax law comes in the budget and loses that and gets the MLD market to become less attractive for investors. So these are some things that the bond market can expect from the budget. Clearly, borrowing is not going to be less than 14 trillion. It's going to be more. States will also have to borrow more. Inflation is high. So to some extent, nominal inflation, which is the nominal GDP, which is not adjusted for inflation, and which goes into the fiscal deficit calculation. If it's higher, then the deficit itself can be kept at below last year's level of 6.8% of GDP. Government would try to show a lower fiscal deficit, but that doesn't mean that borrowing itself will come down. And if RBI is continuing to increase interest rates, then you have a situation where a central bank is not buying bonds. Investors will have to take up the bonds. And if investors they have to take up bonds with more supply, then yields will have to go up. Unless there is a increase in with the Indian government bond being included in global bond indices, there could be good amount of foreign portfolio interest in government bonds that could take up some of the supply. And also if the government itself goes in for foreign currency, so sovereign bonds issuances, and if that happens, then that could also enable a wider reach to other outside investors. But for that, the currency has to be steady. Currency, Indian rupee has been depreciating, trading at close to record lows. So it's down from record lows, but it's still trading at around those levels. And if any kind of issues, macro economic risk aversion takes place again, which has been happening for a while because of global inflation, then the rupee itself could depreciate, and that could make the cost of raising foreign funds much higher for the government. So budget itself is not great. Expect more borrowing. Taxes on capital gains, MLD markets can see a setback if if the government brings in the 3 year lock-in for indexation, and also maybe more thrust towards foreign participation in Indian government bond market and overall Indian corporate bond market as well. Thank you very much for listening in. Follow us on all podcast channels. And if you're a financial advisor, log into our partner portal, see the best bonds available for your clients with the most information. Get the best risk portfolio returns for your clients through bonds on a risk-adjusted basis through our curation, and with the most seamless investment process. And download our app, Quick Invest by INR Bonds, for the best curated list of bonds on offer with our own proprietary risk score and also a very strong and easy in-app investment process. Download the app now.